Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report, our weekend show. This weekend focusing on some of the market moves broadly in the first half of this show, recapping inflation data, looking ahead to next week with the inauguration of President Trump, as well as a few central bank meetings, but the big central bank meetings coming the week after. And in the second half of the show, we're going to be talking energy. Just as a reminder, this weekend, Chad and I are at a number of conferences in Vancouver. As you're listening to this on Saturday, we will be at the Metals Investment Forum. And then Sunday, Monday, we will be at the Vancouver Resource Investment Conference. If you are in Vancouver and at any of the conferences, please drop us a line. We're happy to meet up with you on the floor of the show. Chad is currently on his way up to Vancouver, but he will be joining us in the second half of the show. To kick off this show, I am chatting with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Marc to Market website. I'll include a link in the show notes to Marc's website so you can keep up to date with pretty much his daily commentary on what's moving markets and key economic data. Marc, we can start off with the key economic data from this last week. It was U.S. inflation data. We had the CPI and PPI that was released. Look, to me, it was more or less a non-event. The markets didn't seem to have too much volatility around those numbers. And quite frankly, from my takeaway from that data is everything was in line with expectations. Inflation does seem a little bit stuck above the Fed's target 2%, but it's also not screaming higher. So in a bit of limbo here. Marc, give us a quick rundown of that inflation data this week, please.
And I think you're right, Corey, that the both measures, the PPI and the CPI, were largely in line with expectations. I'd say, if anything, the core CPI was a little bit softer than expected. Actually, it slipped a little bit to 3.2% from 3.3%. But of course, the real takeaway from both the CPI and PPI is what does it mean for Fed policy, and what does it mean for the PCE deflator that's reported later this month? And that's, of course, the measure of inflation the Fed targets. So after we get the PPI and CPI, what it looks like is that the PCE deflator is going to come in at around 2.6%, up from 2.4%. And that's consistent with the 0.2% increase we saw in the headline CPI. The core PCE deflator, though, looks unchanged at 2.8%. So what does this all mean? It means that the Federal Reserve is not going to be in any hurry to raise interest rates. Remember what the sequence of events has been: that strong U.S. jobs data, stronger than expected for the month of December. And then we had these inflation numbers, which were firm, but in line with expectations. So the market feels very confident that there's not going to be any Fed action at this month's meeting. That's on the 29th, the meeting concludes. But I think what's happened this week is that comments from Federal Reserve Governor Waller, and Waller's important because, one, he was perceived to be a hawk, and secondly, he's seen to be a possible candidate to replace Powell as a chair when his term expires. So Waller is basically, even though, as I mentioned, his reputation as a hawk, he's been sounding very dovish in the past few days, including playing up the possibility that the rates get cut here in the first half of the year. And Waller's argument is basically, it's pretty straightforward and simple. I can sum it up in a couple of sentences. It says most of the things that go into the core PCE deflator, those prices are rising at a slower rate than 2%. Those components that are rising at a faster than 2% rate are about a third of the basket, but they are the part of the basket that is not directly observed, like the price of eggs directly observed. But how do you calculate owner's equivalent rent, for example? These, he says, are imputed. And that's where the inflation, the residual inflation, is to be found, is in these imputed costs, not in the directly observed costs. So Waller says we, policymakers, ought to put more weight on those prices that we can actually directly measure, less emphasis on those imputed costs. So bottom line, Waller, a hawk from the Fed, sounds a bit dovish. And what the market has done is after the jobs data, early on Monday, as this week began, the Fed funds futures had the first Fed cut, I should say the next Fed cut, priced not until 2026. And despite the data we've had, it's not just inflation data, but we've had stronger than expected retail sales, especially those core retail sales, stronger than expected industrial production data. And the market, though, seems to be settling with the next Fed cut to be somewhere around the middle of the year, whether it's June or July. It's very closely priced for around then. So I think that's really the takeaway this week is after the strong jobs data, inflation data, the strong real sector data, the Atlanta Fed now saying the economy's tracked 3% growth in Q4. The market feels comfortable, or more comfortable than it did, sort of settling around the middle of the year for the next Fed rate cut.
So overall, again, the U.S. economy seems to be doing okay. Yes, jobs data has been slowing broadly, and as I said, inflation is kind of stuck. It does seem like a lot of eyes still being very much on inflation to target when the Fed is going to cut next, but the market's coming a bit more in line with what the Fed told us recently in their dot plot. What about the energy sector right now? A lot of people say just how much energy, oil, natural gas plays into this inflation data. And look, we've had a strong move in oil and natural gas, especially in this last month. Mark, is that a concern then that will trickle into future inflation data?
It could. I think, two things. One is how we measure it. And of course, the price of gasoline goes up. As consumers, we feel it's like a tax on consumption. The more money we spend on filling the car with gasoline, the less money we have on other discretionary purposes. So typically, I think the Federal Reserve has been right to see higher energy prices as really being a deflationary, even though it raises the price of some goods. Remember, inflation is really the general price level. But I think to your point of why, like maybe thinking more about why energy prices have gone up, partly, as you know, we've been in a bit of a cold snap, not only in the United States, but Western Europe as well. So one is just seasonal weather. Secondly, the U.S. recently announced new tighter sanctions on Russia and the energy sector, including shipping and insurance. And this is seen to be really a significant tightening of the sanctions and will be affecting the supply of Russian oil in the market. Already, by citing vessels, it looks like China and India may have become more reluctant to take that Russian oil, at least initially. And thirdly, I'd say with oil, as you know, the government estimates how the private sector inventories are every week. And for 8 weeks in a row now, U.S. inventory of oil has been falling. And so you couple the weather, the geopolitics, with this more of a technical thing about the reduction of U.S. inventories. And I think you have this squeeze in oil prices. But as far as the overall inflation, so on one hand, we all know that U.S. 10-year yields have jumped over 100 basis points since the Fed cut interest rates in September. And so I try to decouple or try to unpack why those interest rates rise. And there's an inflation component to it. But that inflation component, I can look at like to say the 10-year break even. So I'm looking at the U.S. 10-year inflation protected security, and I'm comparing that yield to just a conventional 10-year note. And that has widened out by about 10 to 15 basis points since the end of September. So it is an increase of inflation expectations, and we've seen an increase in inflation expectations in surveys like the preliminary University of Michigan survey for January. But I'd say the larger part of the rise of interest rates seems to be a readjustment of market expectations about the overnight interest rate. And so I'd say that so far, the rise in oil prices hasn't really fueled or spurred higher inflation expectations, at least here in the States.
Okay. Hey, well, that's something for us to watch because oil, after this strong last, let's say, 1 month run, recently hit a 5 month high right around that $80 a barrel. This also ties into Trump's inauguration coming on Monday and the whole theory of he is pro energy. His whole term is drill, baby, drill. Now, I know coming up in the back half of the show, we're having on Dan Steffens. He doesn't think that that is going to filter through to increase U.S. production. But Mark, you're more of a generalist here. What do you think? Do you think Trump could do anything that could increase U.S. production early on when he enters office?
What I'm watching is that it seems to me that the shale patch might be peaking. It might be a technological peak. That we've exploited this incredible technological innovations. We've gotten a lot of the sort of the relatively easier access. And so I think that, the Treasury Secretary nomination, Bessent, had talked about having his policies. I think people are calling it the threes, 3% GDP, which it looks like we've grown in Q4. He wants to reduce the budget deficit to 3% of GDP, and he wants to boost U.S. Oil or energy output by 3 million barrels. I think it's going to be tough. I think that, we know what's going to have to happen. In order to do that, more of the country's land, more of the federal government's land has to be turned over or made accessible to oil companies. We'll have to see if that actually happens, but that's the direction that we have to go. And like I say, it seemed to me, just like you say, from a very general level, that the shale is, if we haven't reached a peak in shale output, we're very close to it. And so the new oil is what's happened with the renewables, that even though there's been an increase in renewable energy generation, there's also greater demand for oil, partly because the supply of renewable energy is not enough to offset the growth in the overall supply of energy. And I'm afraid that's what's going to happen in the States too, that even if the new administration is able to find ways to get more oil, there'll be other things that seem to be maturing, like that shale patch.
So when Trump enters office, look, it's going to be a holiday in the U.S. on Monday, but there are rumors that there could be a vast array of economic or of executive orders being signed. Anything on your radar here, Mark, that could directly impact markets right away early next week?
Yeah, I think that, this is really the bet that people are making on some of these event websites. We can bet on certain events. There seems to be strong bets in favor that there's going to be tariff announcements within the first 48 hours. But when we think it through, remember, it's not just what the U.S. does. And when you look at these different scenarios, what the U.S. does is important, but what's also important about how the markets will react is whether other countries retaliate, how quickly they retaliate. Canada and Mexico, ironically, the U.S.'s trading partners, part of the USMCA, have already threatened tit for tat retaliation if the U.S. puts sanctions on them. And of course, this is the USMCA and there's a conflict resolution mechanism. But I think that most people are going to be watching tariffs on day one. The deregulation, the increased energy, I think that'll all be coming. And I think to keep in mind just the bold plan, right? The larger plan, I think, is something like this, that Trump administration realizes that this is a one term and that biggest stuff has to be done in the first 2 years before the congressional midterm elections. So I think there's no reason to doubt that the Trump administration 2.0 is going to hit the ground running. And I think that we should all be prepared for a lot of drama in the first part of next week.
Yeah, all eyes really just being on these first 2 years. I've heard so much about how important these first 2 years will be since it is such a red sweep from that election. And hey, we all know how quickly Trump can work. So boy, oh boy, next week, probably volatile on the back of that. But this last week, it was a strong week for the markets. The S&P rebounded up over 3% as we're chatting. It's back slightly above that 6,000 level, which, hey, the all-time high recently was the 6,100 level. Mark, what's the market pricing in here? Is this just a bounce and more of a downtrend? Give us your take on the market rebound this last week.
Yeah, I think that this is still part of this Trump trade. I think people expect a deregulation, corporate tax cuts. Remember, the tax plan that he passed in 2017, that's set to expire. So he wants to extend that. That's at least from the Treasury Secretary's confirmation hearings. That is the first big emphasis, first big priority, extending, possibly making permanent those tax cuts. I think we should also be prepared for more M&A activity. I think there's a broad criticism of the Federal Trade Commission under Biden, and I think that whether it's private equity, whether it's in the public markets, I think we should be prepared for more mergers and acquisitions. that this is the economy's consolidation, and it's sort of switching the assets around a little bit in the direction of greater concentration. I think also one of the things we've been talking about for a while has been in Trump's first term, there was an attempt, they thought, to privatize, to withdraw the government from its ownership of Fannie Mae and Freddie Mac, which, as you know, they buy those mortgages that the banks generate. And there's talk that both of those can be privatized again, that is, the government to pull back. Both stocks are relatively cheap, call it $5 to $6 a share. They've been very volatile. Already this year, they're up like something like 75, 95%, as people, including myself, think that part of the deregulation move is going to be pulling the government out of those two.
Since we're early on in the year, then, Mark, last year really seemed to be dominated by AI, that trade continuing, but also a rotation of money into the broader markets and some of those lagging sectors. What are you buying right now? Where do you see some leadership early on in these markets?
Well, I'm not smart enough to figure out the next big thing, but it does seem that from what I read, that after AI, it's like sort of like how applying AI, what is partly what it means is other like computer revolution, if you will, quantum computing. So there's an ETF that I bought. Stock symbol is QTUM, a US ETF for quantum computing, but it takes a wide like slice of what counts. So the chips would be in there as well, for example. So I like the idea as far as the theme, quantum computing. I think that AI, it sort of builds on, it's not equal to, but can assume or absorb part of the AI meme and focusing on quantum computing, which I think is going to be, we think about AI and, whether it's Claude or Bing or whatever, as what like incredible like access that's given us over the last couple of years. But quantum computing, I think, is going to be just as revolutionary. Think about just security. Think about how crypto works and how quantum computing can change all that.
Is this just more big tech then? Quantum computing to me also means that, hey, I'm sure big tech's going to have a hand in it. We've already had news out of big tech companies on this sector.
Yeah, I think that you're right. I think that's part of the strength and the weakness of it. Is it's sort of just a refined tech story. It's like the next part of tech. But I agree with you that it does have that overlap of this profit taking in tech, there'll be profit taking in the quantum element too.
All right, let's move over to commodities then. US dollar mostly flat this week, right around 109, but that hasn't slowed down gold's run. Gold is up, I believe, a little over $100 just from the beginning of this year, as we're recording this right at around 27.50. What's driving gold? Because some of the news that I saw, ceasefire out of the Middle East, you would think that could pull gold down. That didn't have an impact at all, but I guess these wars, I hate to say it, are kind of old news for these markets. So, what's the driver behind this gold strength to start the year?
Yeah, well, first, I agree with you. It's really, gold was at the end of last year, we were sort of probing 2,600 in the spot market. I think there's been three things or so that have really helped gold. One is that as China reported its reserve figures, they acknowledge that PDOC has resumed buying gold. So one is, that there's a so if you want to buy gold, you now feel a little bit more comfortable or confident. There's a big player behind you that's also really buying gold. Secondly, I think that there's a lot of geopolitical uncertainty. It's not just about the Middle East war, Ukraine and Asia. I think it's just the great uncertainty. Trump's refusing to rule out taking the Panama Canal, taking Greenland or part of Greenland. I just think that in this great uncertainty, gold looks like as a place to hang out. And thirdly, I'd say that the I think people see some financial assets being rich, and gold as it had pulled back to the lower end of its range looked like a lower risk buying opportunity. But we're stalling here. Sort of where we stalled in November was around 27.21 in the spot market. We stalled in the middle of December, 27.26, and this week it looks like we're stalling around 27.25. So I just think that we've moved from the lower end of the range to the upper end of the recent range. Again, only it's about a 2 month range. So I like gold. It hasn't really proven itself. And I think that if you think that US rates have come close to a peak and that the dollar may be vulnerable to a buy the rumor, sell the fact on either Trump or his tariffs. I can see gold going higher, but I'm afraid it will have to first do a little bit of work still, maybe below 2,700.
Really seems to me like gold is repriced though. If we're talking 2,700, these are record levels for gold. And yeah, look, we were chatting about 2,000 being a key level. This whole repriced gold price, what does that mean to you?
Yeah, when I look at a chart, it seems to me that the big push into gold, maybe two big pushes. One is the great financial crisis, and secondly, when the US, Europe froze Russia's reserves after the invasion of Ukraine. And so I think that the concern, I think, is something like this, that maybe going forward, that the dollar, which had been this public good in effect, that the US provided, not selflessly, of course, there's great self-interest in it as well, but this public good making trade easier when you have like one basic, when you have a numeraire, they call it. You have one currency that's really the key. And so I think people think that world is coming to an end. And the re-election of Trump, I think, partly fits into that narrative. It's a throwback, I think, to a pre-free trade era. I mean, in effect, I think Trump is right that before we had free trade, tariffs, how high the federal government in the U.S. funded itself, tariffs. And that was really the debate throughout like the 19th century, whether you have a high tariff or a low tariff. And so instead, by having free trade, that gets rid of the tariff as a significant source of revenue. So Trump wants to bring that back. And I think that uncertainty about the role of the dollar, the role of this public good, I think also favors gold. And then if you think that U.S. interest rates have had this big rally, are going to also come back off, that we came close enough to, people are talking about 5% on the 10-year. We got about 480, and we've backed off to, say, the high 450s. If you think that we have lower interest rates coming, I think that's also, or if you think the dollar is going to be this buy the rumor, sell the fact, either one of these, I think, would say that the gold pullback, which we look for to buy it again at the lower end of the range, close to 2,600.
Mark, I'm curious. In the sphere that you work in, mostly in the currency sector, but again, in New York, around New York, and throughout the country through your travels, are you hearing anybody talk about gold stocks and the potential undervalued nature of them compared to this whole new gold price we're talking about?
Yeah, I mean, I do hear people talking about how the gold miners have lagged, and there's this hope, of course. It's sort of like we talk about in the bond market, people trying to pick a top to JGB that's a low point in the yields, and how the people have dubbed that the widowmaker. And I worry that my friends for a long time, because gold, as you say, it's not just that gold is high now, it's been sort of consolidating their record levels. But the gold miners have lagged. And I think that I know many people who are trying to stick with the gold miners, thinking that there's going to be a catch up. I can't really explain why they haven't participated, but I think that gold, besides a metal that you can take from the earth, it also has this financial role that it plays. And I think that's been more the driver than the gold bullion itself from the mines, more what gold represents rather than the actual physical.
Yeah, it's just been interesting to see, right? People that wanted to play that gold price thought that it would go higher. They've done well simply buying gold or even buying leveraged gold ETFs rather than diving down into the stocks. Maybe that environment changes. Just interesting to hear what you're hearing. Let's also talk Bitcoin because look, Bitcoin up above 100,000. It even touched 105 today. This has been a strong run for Bitcoin. Could very much just be the fact that Trump is entering office. But look, this is a volatile market, but it's back over 100,000. What's important in your eyes?
Yeah, I don't think this is just that Trump is getting to office and he's surrounding himself by people that are sympathetic to crypto. But I think that among the executive orders that are being rumored will be some recognition of crypto and Bitcoin in particular. Not only is there some pressure for the federal government, but even some state governments talking about having some kind of Bitcoin in reserve. I think it's really foolhardy, but what can you do? I mean, I think there is some widespread. I think that this anticipation is really one of the things that with Trump's election, with these executive orders, crypto will go like legit. It will go like more mainstream, people think. Because the people will be helped by this. Even this talk about having the U.S., they would need to change the rules, the Federal Reserve's mandate that the Federal Reserve now, I don't believe that it's mandated to hold anything besides gold and some hard currencies in reserves. To change that, to hold crypto, probably would require some kind of congressional action. But I think that who will it help if the U.S. have to, in effect, sell U.S. Treasury bonds? That's to raise money to buy Bitcoin. I think the people who would be helped would be people who currently own Bitcoin. And I think that's why it'd be done, is this vested interest here. But I think that's what's driving this, is the anticipation that under Trump's second administration to take positive action early on that's going to bring Bitcoin more to the mainstream, including this talk about having, whether it's the federal government or state governments, to have reserves in crypto.
Oh, that would be just a huge driver, though, wouldn't it? If we saw something out of the U.S. on the government front actually buying crypto and holding it into reserves, even on top of what we're hearing from potential companies doing that, that follow through would really be what's important here, because we've had so much talk around the potential of crypto being added to either large institutions, large organizations, or governments' reserves, but we haven't seen much follow through yet, have we?
Yeah, so I'd say that people are like, they're not sure yet. So there's just like some people trying to anticipate this. But I think that this is one of the biggest rallies Bitcoin has had since the election. And even now, Bloomberg has a report out saying that um, the talk is that Trump could release an executive order making crypto a national priority as soon as day one of his term. So I think this is why I say this is partly, it seems to me, the part of the Trump trade. People are anticipating some actions on his first day in office that will shake things up.
All right, Mark, let's shift our focus to next week then. Couple central bank meetings, but it's the following week that's most important. And again, Trump's inauguration, so probably some executive orders. Who knows? Maybe even some tariffs. What's going to roil markets? What do we need to expect out of central banks?
So next week, the key, I think, the three big events you've got, as you mentioned, the inauguration, which, as you say, is going to take place when the U.S. markets are closed. So that's going to be thinner markets, which allows for more volatile action. Secondly, it's already, we're already far enough into January. We're going to get the January preliminary PMI. And the end of the week, the highlight is the Bank of Japan meeting. And that's one of the developments this week. The market feels more confident after two senior BOJ officials talk, the governor and the deputy governor. The market feels much more comfortable about a rate hike from the Bank of Japan at the end of the week. The market's now got almost 25 basis point hike priced in. This had initially sent the dollar down to about 155 against the yen, from which it's recovering a bit here today. But I think that was the two big things, really. I mean, for this week, driving the yen higher, expectations of the BOJ to hike rates, and the softer U.S. 10-year yield. What this means, too, though, I think, is if the BOJ does not hike rates, that the yen will sell off hard. On the other hand, remember what happened in July when the bank raised interest rates? It caused a bit of turmoil in the markets. This was the unwinding of the carry trade and that. And so what happens now? I think that the Bank of Japan is going to raise rates unless Trump's first couple of days really roil the capital markets. The markets go crazy, and I can't really define crazy. I think it's one of those things, you know it when you see it. The markets go crazy. I think that the BOJ will have to hold off raising rates. But barring that, I think the BOJ is set to hike rates, and I think that it might even be a dovish hike. And by that I mean they hike rates, but indicate that it's going to be a while before they hike rates again. By a while, I mean the market doesn't have the next hike priced in until late this year.
So before I get you out of here then, Mark, just a broad comment, high level view of the markets and investors positioning here. Do you consider the bull versus bear narrative to be maybe a coin flip right now? Are investors taking a more defensive position? Are they all bulled up? Where do you see positioning of investors?
Yeah, I think that people are still long. I think that once again, we had this pullback and people were really eager to buy the pullback and to jump into those same names that they were in previously. The market does still scare me. My sense is most broadly that there might be some more gains to be made. People want to be in this for the ride of Trump's early days. But I think that in the other markets, we might be prone to a little bit of buy the rumor, sell the fact, but not right away. Maybe by the end of next week or so, it begins materializing. So I'm trying to be cautious here, thinking that we've gone a long way. I'm thinking about the bonds, thinking about the dollar, and even with the stock market, how quickly we've bounced back here. It sort of tells me where people's biases are. I don't want to fight it quite yet, but I think it's getting a bit overdone again.
All right. Marc Chandler, managing partner at Bannockburn Global Forex, also editor of that Mark to Market website, which I mentioned I will be posting a link in the show notes to. Marc, great having you on the show. Thank you very much for your time. Everyone stick around. Going to be right back covering the energy sector.
Good luck to everybody. Thank you.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, now time to switch our focus into the energy sector that has been quite exciting recently, with crude closing in on $80 a barrel as we're recording this on Wednesday, and natural gas up above $4. We are chatting again with Dan Steffens, president of the Energy Perspectives Group. We're going to cover what's driving the natural gas and oil prices, as well as get into a few companies, some that Dan has already introduced to us, and updating on some other ones. So Dan, let's start off with natural gas. That has been much more exciting, I guess we can say, since natural gas has really been going up throughout the fourth quarter of last year, and has more or less continued that rise in January. Again, it's over $4. We all know that the weather has been a bit colder. Weather does impact the natural gas price quite a bit. But Dan, is that the only reason why natural gas is rising in your eyes?
Well, I think there was this belief that we had this big glut of natural gas, which we did. At the end of last winter, we had over 700 BCF more than the 5-year average in storage. So we had this surplus to work off. Well, as of today, that surplus is gone. As of the day we're recording this, it's probably back to the 5-year average. That won't be reported until a week from tomorrow, but based on the storage draws I'm expecting, we're going to be below that. And then by the end of January, it now looks like we're going to be 100 BCF below the 5-year average by the end of January. And the long-range weather forecasts that I get have this cold extending into February, at least the first week of February. But the next week, the week ending January 24th, I think the update that I got now, they're looking at a draw from storage of over 300 BCF for that week. So it's going to be, but that's not the only thing. It's LNG exports are quite a bit higher, setting new records every day almost, as Cheniere's Train 3 down at Corpus Christi is ramping up. Plaquemines is now ramped up to almost full capacity. And so we're exporting about 3 or 4 BCF per day more than we did a year ago in January. So at this time last year, the Freeport thing was shut down. The Freeport export facility was shut in, and now it's going full speed.
Well, Dan, I'm glad you brought in the LNG terminals, because that's been a big topic of discussion on our show and really out in the larger universe as far as nat gas prices. Obviously, the cold weather helps. There's always a seasonality and weather factor to nat gas, but these LNG terminals are really a more permanent thing that's going to be happening for years moving forward, not weather related. Do you think it gives the United States a slight edge over Canada in the sense that Canada doesn't have their export facilities built yet? They have 7 planned. There's 1 being constructed in British Columbia, but right now the U.S. has dibs on more export capacity. Does that give the U.S. an edge in the nat gas market to close the gap on the high prices you see in Europe or Asia?
Yeah, I believe now that the surplus from last year, because we had 2 mild winters in a row, we've worked off all that surplus now. So if we just have normal weather after January, we're going to be a very tight U.S. gas market. And we have pipeline export limitations out of Appalachia, which is our biggest supply of gas in the U.S. And we have pipeline limits out of the Permian Basin, which is also one of our big gas areas. So, South Texas has ample pipeline. The Haynesville has some pipeline capacity left over, but pretty much that's about it. So it's like we can't just drill and increase production in Appalachia and the Permian Basin if there's no pipelines to hook it up to. So we're kind of restricted down here. And I believe we are facing a bidding war for supply that will be like what we saw in August of 2022. So any of your listeners, if you just go look at like a 5-year chart of natural gas prices, what you're going to see is in August of 2022, because of bidding war between the utilities and the LNG exporters for physical supply, the natural gas price went over $9. It didn't stay there for long, but it was a good 3 or 4 weeks where a lot of these companies could have locked in some really good prices. And then it did, and I really think that the period of gas below $3 is probably over. That was an extremely, uneconomic price for a lot of these guys. So, but if you look at a lot of these big gas producers at $4 gas, they are extremely profitable at $4 gas prices.
So, Dan, when these LNG terminals come online, what companies in the natural gas space are the ones in your eyes that will benefit the most from that?
Well, one of them at the top of the list is Antero Resources, which is symbol AR. And that is because they have got pipeline contracts that they can pump gas into what's called the tier 1 area of LNG exports, where they actually get a premium price for their gas. They can get their gas down into southern Louisiana. If you go to their website and look at their reports, they show like a map of where gas prices are higher along the Gulf Coast. And they could get about 70% of their gas down there, I think. And I think they're getting 25-30 cent premiums on their gas. That Plaquemines facility of venture capitals just opened up down there. It's more than a 2 billion cubic feet a day export facility, and it needs gas supply. It needs steady gas supply to keep filling those, LNG tankers.
Well, Dan, you've also mentioned a couple other nat gas stocks to us in the past, and even some new ones that we haven't discussed. Do you want to cover any other nat gas stocks do you think give investors an edge right now?
Yeah, one I think, and I'm just mentioning, it's a smaller company, and it just doesn't get the Wall Street coverage that these other ones I'm going to tell you about do. It's Crescent Energy, symbol CRGY, and it is in South Texas. It's primarily an Eagle Ford company. They do have some Uinta gas out of Utah that also has good pipeline access, I think. And on a BOE basis, about 70% of their production is natural gas. Now, they still get 70% of their revenues from oil sales, but that company has got a strong financial backer. They closed the merger with SilverBow Resources, and it's like the second highest producer in South Texas. I think EOG is the only producing company that produces more than they do. It just doesn't get the coverage it should, and it's going to get a real nice revenue boost from these higher gas prices. And it does have access to the Gulf Coast, where it can get NYMEX like prices. It can get like the $3.50 to $4 gas price. Where in the Permian, the one thing, if you're just looking at companies that produce gas from the Permian gas is still going to continue to trade as a deep discount to Henry Hub gas prices. And the reason why is the pipelines control it, and they're all full. They can't take any more gas, so they're not able to pay the higher prices for it. There's no bidding war for gas price out there with the pipelines.
So, Dan, when you see these higher prices, natural gas prices, and they stick around for a little bit, obviously it makes sense. That's going to run to the bottom line of these companies. What or how do you play it around earnings reports then? Obviously you're buying kind of before, but what is your strategy when these companies start to report these earnings and actually show the market just how much better they've done?
Well, like about a month later, after our last interview, I started updating all my 25, 26 forecast models, and I'm using $3.25 for the first quarter and $3 for the second quarter. Well, obviously, they're going to get prices way above that. And then I adjust each company for regional differences and for their hedging contracts. But yes, it's going to have a significant increase. I mean, you're talking about more than 10, 15, 20% increase in their realized gas prices, and they produce a lot of gas. These, Antero, the other, let me give you three more, is Coterra Energy, CTRA, EQT Corp, which is the second largest gas producer in the U.S., and Range Resources, which is RRC. And Antero, Coterra, Antero, EQT, and Range are all Appalachian companies. Now, they're big enough and they have long-term marketing contracts with the pipelines. So they can get their gas into the pipelines. Now, they can't ramp up their production much because there are pipeline limitations, but they produce so much gas already that these prices are going to go right to their bottom line, and they look really good. And Antero has none of their gas hedged. So if you really believe in higher gas prices, Antero Resources is your pick, AR.
Well, Dan, just one more question on just the nat gas pricing itself and what these companies could lock in. I remember talking to a lot of other energy people back in the beginning of 2024 when we saw nat gas get down to 150 and then, $2 and hover there. And I said, is it possible by the end of this year that we're at $3 to $4 gas? And a lot of them shot the idea down. No way. We're probably going to be stuck down here forever. Well, sure enough, at the end of last year, we're at $3 to $4 gas. And you were one of the only people we brought on the show that said, yeah, that's totally possible. So I think that you've been hitting it pretty well as far as your nat gas pricing. You said you used $3.25 and then $3 for the first half and second half of next year. Do you think it's possible we go to $4 and stay above it for most of the year, or even hit $5 as a result of the combination of weather, not just the LNG terminals, but also the increase in nat gas and power and electricity generation?
Yes, and that's another thing, AI power generation. And I've heard a lot of people talk about, these small nuclear power plants. Yes, long term, that's the solution. But in the near term, building these modular natural gas fired kind of mini power plants, there are multiple AI data centers, and they're using this company, Solaris Energy Infrastructure, SEI, to build these for them, and they can right size for them. These are, just think of it as a Generex, a giant Generex that you put next to your house, but this one's as big as a freight car, and you can hook them together, as many as you need. And here's the thing with these AI companies. Remember, these are multi-billion-dollar market cap companies, and they have a lot at stake. Their stock prices are priced to perfection. They will pay whatever it takes to get these power plants set up so they can open these data centers, because they're doomed. I mean, if they can't open these data centers, then they're out of business. So it's going to be, SEI is in a really good position.
Dan, what about internationally then? As much as we talk about how LNG terminals will help spread North American gas around the world, and look, cold weather in the U.S., yes, that drives the natural gas price. What are some international factors that can drive the natural gas price?
Well, the entire northern hemisphere has been colder than normal this winter. It's been cold in Europe as well. And natural gas prices in Asia and in Europe today are over $14 per MMBTU. So even if you're paying $4 for the gas, it takes another $2.50 to turn it, to liquefy it and export it and transport it over to Europe or Asia. You're still getting a giant profit margin. And in fact, who was it? HFI, I think, they did a report on it that said to get to price the LNG exporters out of business so they would stop exporting, you would have to have a gas price of $8 to $10. And probably what would happen is if it went that high, you would also see the prices in Europe and Asia go up. I mean, a couple of years ago when the whole Russia-Ukraine war started, there was $30, $40 an MMBTU prices in Europe because they were just struggling for supply. And because of the cold winter, they are draining their storage, even faster than we are. So it's going to be tight. And I think the international market for U.S. gas and for Canadian gas, isn't Canada's opening up an LNG exporter facility, isn't it? In a couple months, they're going to open that up.
Finally. Yes, they're going to get one, but they're very far behind the U.S.
Yeah, and I also heard that their gas supply is already pretty much spoken for that export facility. People have already contracted for it. So maybe the little guys won't be able to get the gas price in Alberta that we were hoping for or something, but it's going to come up. I mean, it's been cold in Canada also, so you guys are depleting your storage as well. It'll take time. But I talked to InPlay the other day, and they said they have not yet seen any significant increase in the gas price.
Well, there's also 6 other planned natural gas LNG terminals in Canada, most of them all in British Columbia for the most part, and the idea to take it over to Asia. So it's going to be interesting to watch that happen for the Canadian markets. Just one more question on how this ties into maybe oil services. You mentioned some of the pipeline limitations, and some of the companies that have pipelines should be doing pretty well. Any opportunities in the oil services or pipeline companies to cash in on this LNG?
Yeah, I really like the pipeline companies. The one I think that's the best value right now is Plains All American. Last time I looked at this, the shares were below book value. There's 2 ways to invest in it. If you're okay with owning a master limited partnership in MLP, PAA is an MLP, and it pays a slightly higher dividend than its percentage dividend than its general partner. They both pay identical dividends. I mean, always have, always will. The only asset that PAGP, that's Plains All American GP general partner, PAGP, and both of them have dividend yields like 8.5%, 9%. But they pay identical dividends. It's just that PAGP, because it's not an MLP, trades at a little higher share price.
Okay. Well, then let's now talk about oil quickly, because oil has been on quite the uptrend as well. Started at the tail end of December when oil was stuck right around, let's call it $70 a barrel. Now it's closing in on $80 a barrel, close to some levels that we haven't seen since more in late summer. What is driving this oil price increase in your eyes?
Well, I think it's kind of political at this point. It's a little bit ahead of itself, if you ask me, but I do think the economy seems to be going well. We're not having a global recession or anything. There's some talk about how China's kind of getting it together a little bit over there. But, we're up to $79 plus the WTI, $81 on Brent. I mean, if it stays there, again, my forecast models that I was updating a few weeks ago, I was using $70 for the first quarter and $75 for the second quarter and $80 for the third quarter. So beyond, the second half. So I was expecting us to get back to 80. But now I think when Trump, and I think this is going to happen quickly after he's in office, which is next week, he will slap the sanction and enforce sanctions on Iran like immediately. And if he does, I don't know if he'll go so far as having U.S. Navy blockade their ships. That could send oil to 90 really quick. And I also think he's going to do something about Venezuela. Now, we need the Venezuelan heavy oil. We need the Canadian heavy oil, which is one reason we're not going to put any tariffs on it. But also, I mean, we've had the EIA today reported about a 2 million barrel drop in U.S. crude inventories, which is like the 8th consecutive weekly decline in U.S. crude oil inventories. OECD inventories, which is the Organization of Economic Cooperation and Development, their petroleum, this is total petroleum inventories, are below normal for this time of year. And if you measure them on days of supply, they're really low based on days of supply. So as long as there's no, recession or depression or whatever in Europe and around the world, inventories are tight. And I think there's this paradigm out there that we have this big glut of oil, and OPEC Plus can increase, oil exports, just by turning a few taps, and they can't. They can over, months of time. But, if they take 1 million barrels of Iranian oil off the market, that's going to have an immediate impact on the oil price.
Well, Dan, since it is a global market, and you brought up OPEC there, a lot of people are worried that OPEC could increase production. Explain why you think it's not possible, and then also bring into the equation the dynamics between Russian oil. Russia is still a huge producer. They're still getting it circulated via India and other countries, but how do the sanctions play into that factor of the oil markets?
Well, the recent uptick in oil prices is because, and this is the Biden administration, they put sanctions on and started enforcing sanctions on these shipping companies, on the tankers. And so they're telling the ports in some of these places that if you allow these ghost tankers that are, really, bypassing, tracking stuff and everything to get Russian gas to market, we're going to put sanctions on you. So it's tightening up the market. But really, to date, there really hasn't that much Russian oil been taken off the market. I mean, there's been some of these drone attacks that have done minor damage to some of their export facilities and refineries, but that's it. But then another thing is, it's cold in Russia too, and they need their own, they don't export as much heating oil in the winter time. So I mean, there's a lot of things. And another thing to remember is demand for oil-based products always goes up about 2 million barrels a day from the first quarter to the second quarter, just because 90% of people live in the northern hemisphere and we start driving more. So demand for transportation fuels always goes up about 2 million barrels a day in the second quarter.
So Dan, with Trump coming in, look, we talk a lot about this drill, baby, drill. And I know we've talked to a number of people that said, look, it's just not going to happen because of the fact that these companies are only going to drill if they have higher prices. To take the, I guess, other side of that argument, is there anything Trump can do to lower the costs for these companies so that they could actually start drilling, increase U.S. supply?
Well, most of the increase in supply is going to be coming from the Permian Basin, but it's already pipeline limited. I mean, it doesn't have the export capacity out of the region. You can't truck that much oil out of there, so it's got to go by pipeline. I just don't think there's much that Team Trump can do to increase U.S. oil production in 2025. Now, yes, if they, open up more federal lands for drilling, or if they lower restrictions, and if they really wanted to do, lower the federal tax royalty on offshore oil or something like that, would give them more cash flow. There might be, some political back from that, but U.S. oil production increased about 1 million barrels per day in 2023 because we were still rebounding from the COVID stuff. But we're really just back to slightly above where we were pre-COVID. We're at about 13.2 to 13.5 million barrels per day, but we've only increased U.S. oil production by 300,000 barrels per day in 2024. And I will tell you that IEA, the International Energy Agency based in Paris, France, not Paris, Texas, Paris, France, they're overstating U.S. production growth in 2025. There's no way. I was listening to a webinar. I wasn't on the webinar, but this panel of experts in the market that does a big panel discussion every year in January, they're predicting that the most U.S. production can go up is 300,000 barrels a day. And the guy who I consider is the most expert says he thinks 200,000 barrels per day increase is the most he sees for U.S. production going up, no matter what happens. Now, over time, technology can do something. We can have horseshoe wells, but there's really no way drill baby drill is going to happen until we have higher prices. And yes, the South Texas, that's another reason why I like Crescent Energy, because South Texas does have excellent pipeline capacity left. So it's a place that could go up. And Central Oklahoma also is a good place that has pipeline capacity left.
Well, Dan, we hear a lot from people projecting higher and higher production from the U.S., and that's obviously what the Trump administration wants. But there's the reality of a lot of these basins are past their peak. With the exception of the Permian, a lot of the basins like the Eagle Ford and some of the other ones are actually in decline. How does that tie in when you talk to companies versus what people are saying, giving lip service to on TV? When you actually talk to the companies, do they have plans to really increase a lot? Because most of the basins are in decline.
The only ones that are really showing big increases in production is because they did a big acquisition. They bought production. So that doesn't increase total production. It increases their production, but it doesn't increase total U.S. production if they just bought somebody. So that doesn't do it. And another thing, and this is something that we've discussed before, in the Permian Basin, the gas to oil ratio continues to drift higher. And I follow literally like 20 companies that are in the Permian Basin. All but a couple of them are reporting increasing gas to oil ratios every month. So their BOEs per day are going up, but it's natural gas and natural gas liquids. It's not crude oil. And another thing is this ultralight oil that comes out of the shale is not suited for making diesel fuel. You need black oil. We need the Canadian oil. We need the Venezuelan oil. We are importing about 6 million barrels a day, and we're exporting 2 or 3 million barrels a day of ultralight oil. So we have to import black oil so that we can make diesel fuel. And the global oil market is much more complicated than people think. And it wouldn't matter if we could double the Permian Basin production. We just have to export it.
Dan, do you think the U.S. at any time, or can we broadly say that the U.S. is running out of oil, or is there still plenty of available oil to be drilled, to be produced throughout the U.S.?
Well, there's plenty of oil, but you get on a treadmill because we are getting most of our production. I mean, 80% of our production now comes from tight oil shale and other tight formations where they drill horizontal wells, they frack the hell out of them, they come on strong, and because these wells have really high depletion rates, they come on 1,000 barrels a day, and 6 months later they're at 500 barrels a day. So you have more and more wells depleting, and so you have to just keep drilling more and more new wells to do it, and eventually you run out of tier 1 areas. So other than the Permian Basin, all the other areas, the Bakken, Oklahoma, Uinta has some upside, South Texas has some upside, but not much. And they're nothing. I mean, in size, they're just nothing compared to the Permian Basin. So none of them can offset that. So if the Permian peaks, the U.S. peaks. And you may have noticed that Joe Biden, one of his, gifts to Mr. Trump was he just put all of the offshore U.S. off the West Coast and the East Coast off limits, and a third of the Gulf of Mexico off limits for drilling. And he's doing it under an act that's like 53 years old that gives the president the power to do that. And he's going to have to go through Congress and the Senate, House and the Senate to get that reversed. So that's not going to happen real quickly. And we definitely need to develop our offshore oil reserves. That's outside of the Permian, that's the only place that really has significant upside.
Yeah, it's going to be interesting to see what the Trump administration does with offshore drilling. But you did bring up a company that you wanted to review today that is drilling a lot of wells, and they are doing a good job with growth, and that's Kolibri Global Energy, traded on the ticker KGEI. You see some good growth potential here, but really outstanding well results. So give us the value proposition for Kolibri Global Energy.
Well, first of all, Kolibri is a very small company. So even though they are having a percentage increase that's pretty high in their production, we're not talking about making any difference in U.S. oil supply. So, this year, back in November, they announced the completion of 3 wells from the same pad. They drilled all the wells first. Then they brought in completion crew, and they completed them all at the same time. They have really good pipeline export capacity up there, so they were able to connect these wells, and there's ample. They are just southwest of Oklahoma City. They're in what they call the Scoop Play, and they're developing a shallow oil zone called the Caney. And they were getting good wells before. They were doing 1-mile laterals, and they were completing a different way. Well, I mean, they actually fired one of their internal engineers, and they, got some experts to come in, and they came up with a new completion method, and they're drilling 1.5-mile long horizontal wells. The lateral section's 1.5 miles long. Now, these wells cost about $6.5 million or so to drill, but they're coming on. These 3 wells all came on at a total for the 3 put together, 2,800 BOE per day, about 65% crude oil, about 10% NGL, so about 75% is liquids, 25% natural gas. Again, they can sell it all right away. In fact, Exxon markets all their gas and NGLs and gets good prices for it. So these wells came on. Now, that took their production from like 3,000 barrels a day to almost 5,000 barrels a day. So they're exiting 2024 at about 5,000 barrels a day. So significant stair-step production increase. So then yesterday morning, they announced their guidance for 2025. And it was actually a little bit lower. But what they are basing that on the previous expectations for these wells, what they call the type curve, that the reserve engineers give them a type curve for those wells. So they had previously completed like 32 other Caney wells. And so they're basing their expectations for this year based on what those wells did. not what the 3 new wells did. And so they're going to drill 1.5 mile laterals, and they're going to drill 8 more Caney wells on their own, where they're like 100% owner of them. And then in a part of their Tishkaminga field, it's called, in part of their acres, they have a 17,000 acre block there. But in part of it, Exxon still owns about half the acres. So Exxon came to them and wanted to drill a test well in the southeast corner of their acreage that's in what's called an unproven area. But the Caney Formation they know is there because Exxon has drilled deeper wells through the Caney. They're producing from the Woodford at a lower zone. And these are really good gas wells. And Exxon owns all the deep rights. There's one more zone called the T zone below the Caney, but below that, Exxon owns 100% of the Woodford, which is below that, where it's a gassy formation. So it's very positive to me that Exxon wants to drill this well. And Kolibri, I think, is going to be the operator well. They have the majority, like 55%, and Exxon's got 45%. But that they wanted to drill this well, propose this well, is very exciting for me because it would open a whole new area of their field and would prove up that area of the field. So that's a plus. So there's a lot of upside for this company. Now, since their November 12th press release, the stock is up 77%, but it's still trading for about half of my valuation. And I believe that their year-end reserve report, because remember, these 3 newer wells, they're called the Alice Renee area. That's the name of the pad, the area where they build them. So it's the Alice Renee 1, 2, and 3. And they're still producing really well. I confirmed that yesterday, still producing above the type curve. And they're going to add a lot more proven reserves. And I think, just back of the envelope calculation for me, their net asset value, pre-PV10 net asset value of Kolibri stock will be like over $12 a share. And it's trading for like $6 a share today. So I think there's still considerable upside. And this is like all small caps. You know, small caps can take off when you least expect it. It can just be one good well result sometime. But their balance sheet's in really good shape. They're able to fund all of their drilling program with operating cash flow. They don't need to go borrow money or sell any more money. And in fact, they also announced a stock buyback program because they believe their stock is very cheap, and that's a good sign also.
All right, Dan. Always great having you on the show. Again, Dan Steffens, president of the Energy Prospectus Group. Everyone, thanks for tuning in to this weekend show. I hope you all enjoyed our coverage of the markets and wrapping up with the energy sector. Please be sure to go back through our website, kereport.com, or podcast. Just search the KE Report in your podcast player to listen to all of our daily editorials and company updates we release throughout the week. This weekend, we are at a number of conferences in Vancouver. As you're listening to this on Saturday, we will be at the Metals Investment Forum, and then Sunday and Monday at the Vancouver Resource Investment Conference. If you're in town, please be sure to drop us a line, and we are more than happy to meet up with you in and around the conferences and discuss these markets even more in depth. So everyone, again, thanks for listening in this weekend. I hope you all have a great weekend, and I hope to see you at some of these conferences. Dan, thanks for wrapping up the show with us.
Great, thank you.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.